Hello and welcome to Livewire's Buy, Hold, Sell. I'm Ali Selby and today we're going back to basics to learn everything there is to know about exchange-traded funds. ETFs have surged in popularity in recent years with now 2 million Australians using them to invest. So to answer the internet's most common questions on all things ETFs, we're joined by Dawes from Shaw & Partners and Andrew Wielandt from DP Wealth Advisory. Okay, let's get straight into it. In layman's terms, Adam, what is an ETF?
So an ETF is an exchange-traded fund, and basically what an ETF is that it is a basket of shares that have been put together. So you buy one share and you get a basket of those shares. So great for diversification, great for getting access to international markets, and it's a way to fill out your portfolio going forward. So an ETF is a very fantastic or great vehicle for investors to get diversification ongoing.
There's hundreds of ETFs available on the ASX.
Lots of them, Ali.
Yeah, how do investors compare them?
Oh, there's a whole range of ways you can do it. Further to Adam's point, it's around diversification and asset allocation. So you might say, I want some Australian shares or international shares or bonds or fixed interest or property or whatever the case may be. So if you use that as your first lens, and then your second lens might be, do I want to be passive? Do I want to follow an index? Or do I want to be active and try and use things like factors, income, growth, momentum, etc. to try and sort of give further diversification to your portfolio?
How would you compare, I guess, similar ETFs though?
So part of it could be around cost, if we're talking passive. If we're talking active though, there are other factors you should be considering. What rules do they use? What other factors are in play? Who are the managers involved? So it's not a simple answer, but a very blunt way of looking at it would be cost.
Okay, really like this next question. Adam?
Yes.
Are ETFs safer than stocks? Yes
and no. Is that a good answer for you? The first answer is yes, because they are more diversified. So you're not just in one stock. And if your whole portfolio was in Commonwealth Bank, well, you would have done very well. But if your whole portfolio was in something like, another stock that hasn't done very well, it would fall. In an ETF, you've got a basket of goods. So your diversification and your risk is a lot reduced. So that's the yes. The no is that they're all in shares. So no matter where you go, if markets are falling, your ETF will fall as well. And especially then with a lot of these thematic ETFs, so in other words, if it's in copper or uranium, all those kinds of things, if that sector does badly, the ETF will do badly as well. So I don't know if I answered that, but there you go. That's, yeah. Yes, they are safe, yes.
They're not all in shares though. There's some more active ETFs that are in fixed income like
bonds.
Products.
Yep, absolutely. So yeah, but most of it is all sort of in that listed space. But yeah, you're right, there are other ones with bonds and things like that.
Okay, over to you, Andrew. Are there any downsides to ETFs?
Oh, Ali, that's a tough question to ask an ETF whisperer, as I've been called previously.
Very proudly called.
Thank you. Proudly. Merchandise coming soon for those playing at home. Look, I think really you've just got to be careful of these thematic ETFs, and Adam just touched on a couple of them before. The uranium ETF has just shot the lights out over the last 12 months. It's up about 55%, but over the last month or so, it's down about 9%. So these thematic ETFs tend to have a bit of a life of their own, and when people love them, they're on fire, but when people don't like them, people dislike them with a passion. So I think it's really just making sure you have that balanced portfolio and saying, if I have a thematic ETF, at what point, if people are no longer engaged with that ETF, do I get out? So that's probably more in that active space. When it comes to passive, you're just buying markets. And we know that by buying markets, there's a 77% chance over 15 years that you'll actually perform in line with the market relative to someone who's trying to beat the market. So if you're taking a passive approach, long term, you should be okay, but it's these active ones that you just need to be a little bit more cautious on.
Okay, next question for you now, Adam.
Yeah.
How much should investors invest in ETFs and how often should they be putting their savings in these vehicles?
So a great way for a young person to get started is to get some ETFs instead of trying to pick single stocks and understand what's going on. So you get that basket. So really it comes down to how much brokerage you're paying compared to sort of that. So I would think that you could, and there's obviously cheap brokerage these days, so everyone should be putting $200 to $300 a month in, and for a young person over a 30-year lifespan, that compounding is amazing. Plus then reinvesting those dividends as well, I think that's absolutely fantastic. So I don't think there's a real minimum as such. Maximum, is the sky's the limit with market makers in there as well. But on the minimum side, I think for younger people, it's a great way to get your portfolio started.
Okay. How long should someone hold an ETF?
Ali, how long is a piece of string?
Yeah.
So again, this active versus passive frame, if I'm a passive investor, arguably forever, because really I'm just buying a market or I'm buying an asset class. It comes down to your circumstances, and of course we've got that little disclaimer somewhere here on that video, I'm sure. But if I'm in thematic land, well, again, coming back to that uranium example before, well, again, you sort of go, well, the uranium spot price has come off 10% over the last month, time for me to get out. So if you're sort of more passive, longer term, if you're in thematic land, look at what's driving that thematic. Is the lithium price off 80%? That's probably not helpful for lithium or battery technology ETFs. Then you maybe need to have a shorter time frame.
Okay, speaking of thematic ETFs, maybe the more poor performing ones.
Yeah.
What happens if an ETF shuts down?
So there's lots of ETFs that get released every year, right? So there's lots of big companies releasing all of these ETFs, plus a lot of managed funds that do that as well. What happens is, why do they, more to the point I think, is why do they cancel them? They cancel them because there's not enough volume that's going through, and it does cost them money each month, each year, to have these ETFs listed on the Australian Stock Exchange or anywhere. So it has to be a business decision, but it also then has to be, like the thematic, it has to be right. So they do cancel these regularly. So what happens is that you get the net asset value as of the date that they say that they're going to close it. So let's say June 30, you'll get the net asset value, the NAV of that ETF. You get that cash back, and then you can go ahead and do what you want. Whether you're in a loss or a profit, that's, yeah, totally, but they will close it, give you your money back, and you're done.
Okay, a little bit more of a difficult question now.
Oh, excellent. Thanks, Ali.
You get all the ones. You get all the questions.
How are ETFs taxed?
So I'm not an accountant, so that's my disclaimer. But if you think about shares, it's pretty simple. You just get a dividend, and if and when you choose to sell them, there's either a capital gain or a capital loss. It's pretty simple. Similarly with ETFs, they're treated somewhat similarly, whereby, again, if I sell them at a gain or a loss, that's one side of it. When it looks at the income, though, there are different components that it's occurring within the income. So you were talking before about international, so there might be some international income in there, or if there's some Australian income, or there'll be some franking credits, or if throughout the year the fund has actually been changing the mix within there might be a distribution of capital. So there's a few more components, but don't stress. On your end of year statement from your ETF provider of choice, they'll actually tell you in box 12 put this and in box 15 put that. So certainly keep your records, that's super important. But there are a couple more moving parts, but it's not insurmountable. Okay,
we asked our guests to bring along their favourite ETF right now, just because I know you all love a stock idea or an investment idea at the end of these episodes. Adam, I'm going to start with you.
Yeah.
What's the top ETF in the Australian landscape?
Going to steal a bit of Andrew's thunder here, but it's Qual, Q-U-A-L. This is a quality ETF. It's basically a fantastic ETF as far as it gives you really great international exposure. If you have a look at the chart, this thing's done absolutely fantastic and will continue to do amazing work going forward. So it's one of our core staple ETFs in every client's portfolio, and I think everybody else should do the same.
Andrew, over to you.
Mate, you're killing me.
I know.
But just following on from Adam, obviously it's Qual, the one ETF to rule them all. But if we think about what the quality ETF holds, it's companies with high return on shareholders' funds, steady to increasing revenue and steady to decreasing debt. And Adam and I have been doing this game for a little while now. Hard to believe with the baby faces that we have.
That's right.
And it's very, 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 very rare that you have companies go bad that exhibit those three characteristics. So that particular ETF holds 200 companies across a range of about 1,500 across the world. To be a little bit different, so we're not matchy-matchy, QHAL would be another one to think about. So that's the hedged version. So one of the reasons why Qual has done so well is because it's unhedged, and the Aussie dollar, which over the last 40 years has sat at around 74 US cents, it's about 65, 66 at the moment. So if and when the dollar does get its act back into gear, and you'd expect that to be the case at some stage, then QHAL might be a way to protect yourself, because if the dollar starts going up, then QAL will come under pressure. So perhaps the barbell, Adam, might be a little bit of QHL and a little bit of Qual, but the two together, a match made in heaven.
Okay. Well, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.